Okay, we're now going to start through the journal entries that manufacturer Southern, the lessee in this case, would make for January 1st, 2016 through January 1st, 2017. Now remember, what we're dealing with here is a capital lease. What you're accustomed to is an operating lease. We looked at those in Exercise 15.1 and Exercise 15.2. I'm sure those were just kind of a review for you. But what we said earlier in the leases lecture, sometimes a lease is drawn up so that it's essentially a purchase by the lessee. And if that's the case, remember it has to be a non-cancelable lease term and meet one of our 4 criteria here. Then we classify it as a capital lease, meaning we treat it just like a purchase by the lessee. So what we're going to do here is debit an asset account, leased equipment, and it gets debited for the present value of the minimum lease payments, the $112,080. Okay, and we'll credit a liability account, leases or lease payable. Probably just put lease payable here, but if you had several of them and you were grouping them together on the balance sheet, we'd call them leases payable. And it's credited for the $112,080 as well. Okay, then also on January 1st, a manufacturer Southern made the first lease payment. Remember, those lease payments were $15,000. Well, on January 1st, no time had passed off, so no interest expense was involved. So the decrease in the balance was $15,000. So our entry here on January 1st would be a debit to lease payable for $15,000 and a credit, of course, to cash for $15,000. That one was really straightforward because no interest was involved here on January 1st. What we essentially did with this entry, it was made for the January 1 row from our lease amortization schedule. We debited lease payable for the decrease in the balance, and we credited cash for the amount of the lease payment. Okay, next we'll go to April 1st, 2016. Okay, so we're going to debit lease payable again. And this entry, you guys, is for the April 1st row. So we're going to debit lease payable for the amount of the decrease in the balance, $13,058. We'll debit interest expense for the amount of interest expense from our amortization schedule for April 1st, $1,942. And then, of course, we'll credit cash for the total of the two, which should be the $15,000. And we know it is, but let's do it like this. Equals, now how about we just do sum of these two. It's going to be our credit to cash. And yes, that comes to $15,000. Okay, next, we're just going through the entries for 2016 and actually 2017 as well. Okay, so we took care of the April 1st row. The next one we'll make is for July 1st. All right, it's going to be the same three accounts affected, you guys. The only thing that's going to change will be the numbers. The debit to lease payable on July 1st will be made for the amount of the decrease in the balance, $13,320. Will debit interest expense for the amount of interest on due on July 1st, 2016. That's $1,680. And then we'll credit cash for the amount of the lease payment, which was $15,000. But just as a check, let's add those two together, and yes, it comes back to the $15,000. See, it's fairly simple once you get the amortization schedule made out. Okay, next, we'll just come down a row. We're taking care of the October 1st lease payment. All right, the accounts to debit and credit remain the same. Only the amounts have changed. Okay, we'll debit lease payable for the decrease in the principal balance on October 1st from that October 1st payment, $13,586. We're going to debit interest expense for the interest due on the out of the October 1st payment, which is $1,414. And then we'll credit cash for the total, which should be the amount of the payment, $15,000. Again, I like to add together the two debits just to make sure each time. Could have keyed something incorrectly. So far, so good, though. Okay, and we would they want us to make all of the entries that are required for 2016 by the lessee. So you might just think now, well, move along to the January 1, 2017 entry. We will make this one. We will make an entry for this row. But we have the year end between October 1st and January 1st, right? The business's year end is December 31st. So we need to make a couple of adjusting journal entries. Okay, first, we want to, let's see how to word this. Okay, first, some interest has built up on this lease from October 1st to December 31st. Right, the interest that's going to be due on January 1st is already owed to the other company by December 31st. It builds up over those 3 months, October, November, and December. So we're going to debit interest expense for the amount of interest that has built up from October 1st, 2016 to December 31st, 2016. So where do we get that number? Well, it's the interest expense that's going to be paid on January 1, 2017. So it's $1,142. We haven't paid them yet, though, so we'll set up a liability, interest payable. This is an adjusting entry, you guys, that would happen at the end of the year. We just want to make sure that we get all the expense recorded for the year. And like we said, 3 months worth of interest expense have built up since the last payment was made. And we also want to show all of our liabilities on the balance sheet. Well, we'll owe that interest if we don't even operate in the new year. Okay? Also, remember, the lessee here is treating this as a purchase because that's essentially what it is. So they're also going to depreciate the leased equipment. They're using it over a 2-year period, so they'll depreciate it over 2 years. That's $112,080. We're going to debit depreciation expense that says they use a straight line method, so we'll say $112,080 divided by the useful life, which is 2 years for this business. So our depreciation expense will be $56,040. And of course, we'll credit accumulated depreciation for the same amount. Well, let's try our calculation again though. It was $112,080 divided by the 2-year useful life, or the useful life to this business is 2 years. So our depreciation expense, our adjusting entry there is for $56,040. Right, now we're ready to make the January, this is going to be 2017. And this is our January 1st entry. Okay, well, we're going to take care of the interest, so we'll this interest payable from the end of last year needs to come off the books. So we'll debit interest payable for $1,142. We'll debit lease payable. This is our January 1st, 2017 row, so let's go over and look at the chart. Notice we debit interest payable rather than interest expense because the interest expense was recorded last year, the year in which it was incurred, not in 2017, the year it's paid in. Okay. All right, so to take the liability off the books, we debit interest payable for the interest expense portion over here. Okay, we're going to debit lease payable for $13,858. And then we're going to credit, of course, cash. For the sum of those two, which should be the amount of our payment, $15,000. And there you go. The only reason this one changed, you guys, is we recorded the interest expense in the 2016 fiscal year, the year in which it was incurred. So we debit interest payable here rather than interest expense. Okay, so after watching those two videos and working this one along with me, I don't think you'll have any trouble with your next homework assignment. That's exercise 15-3. Thanks a lot.